Okay, let's talk about investing. If you're starting from scratch, feeling a little overwhelmed by all the jargon out there, you are in the perfect place. We're going to cut through all that noise and give you a super simple step-by-step guide. Ready? Let's dive in.
So I'm going to start with a question that sounds a little dramatic, but it's totally true. Did you know that if your money is just sitting there, say in a regular old checking account, you're actually losing money? It's getting weaker every single day. And the thing responsible for this is called inflation.
So what on earth is inflation? Well, think of it this way. It's the reason a candy bar that cost a quarter when you were a kid now costs $2. Your money just doesn't stretch as far as it used to. Imagine you've got $1,000 stashed in a jar. In 10 years, that same $1,000 might only buy you what $800 buys you today. And with inflation in the US averaging about 2 to 3% a year, well, that adds up really fast. Investing is how you fight back.
But, and this is a big but, before you even think about investing a single dollar, we have to talk about building a solid foundation. You know, you can't build a house on shaky ground, right? It's the exact same thing with your finances.
There are 4 things you absolutely have to do first. These are non-negotiable. We're talking about getting rid of any high-interest debt, building up a cash safety net, making sure you've got a steady income, and of course, learning the basics, which is exactly what we're doing right now.
Let's focus on that debt part for a second. See this number, 20%? If you have a credit card charging you 20% interest, paying that card off is mathematically the same as getting a 20% guaranteed risk-free return on your money. I mean, think about it. You will never find a deal that good in the stock market. So the takeaway here is simple. If you have debt with an interest rate over, say, 6 or 7%, make that your #1 priority.
Okay, next up, the emergency fund. This is your financial fire extinguisher. Life happens, right? You could lose your job, the car could break down, you could have a medical bill, you get the idea. Having 6 to 12 months of your basic living expenses saved in cash means you'll never ever be forced to sell your investments at the worst possible time just to cover a crisis.
All right, so once you've built that solid foundation, it's time to do a little self-reflection. Because a good investment strategy isn't one size fits all. It has to be tailored specifically to you. And that brings us to 2 really important questions you got to ask yourself.
First, what's your time horizon? In other words, how long can you leave this money invested without needing to touch it? Are we talking about a down payment on a house in 3 years? Or is this for retirement, maybe 30 years from now? The longer your timeline, the more risk you can generally take on. And second, what's your risk tolerance? And be honest with yourself. If the market took a nosedive and your investments dropped 20% next month, would you totally panic and sell everything? Or would you be able to stomach it and stay the course? Your answer really, really matters.
Okay, now for the fun part, the main event. Let's actually talk about the different things you can invest in. We're going to walk through the main options, starting with the absolute safest and working our way up to the riskiest.
We're going to start at the very bottom of the risk pyramid, the safest place you can put your money. Now, a high-yield savings account isn't technically an investment for making you rich, but it is the perfect home for that emergency fund we just talked about.
Here's the deal with these accounts. They are government insured, so your money is safe. You can get your cash out whenever you need it. And the best part? Right now, a lot of them are paying interest rates around 4 or even 5%. That is way, way better than the practically 0% you get at a big traditional bank. It's not going to build massive wealth, but it's a great way to make sure your emergency cash doesn't get eaten alive by inflation.
All right, let's take one step up the risk ladder to bonds. This might sound complicated, but the idea is actually super simple. When you buy a bond, you're just lending money to a big organization, like the government or a huge corporation. In exchange for that loan, they promise to pay you interest on a regular schedule. And then, at the very end, you get your original money back.
So the big reward with bonds is that predictable, steady income. But what are the risks? Well, there's a tiny chance the borrower might not be able to pay you back. That's called credit risk. But the bigger risk for most people is something called interest rate risk. Imagine you buy a bond that pays you 3% interest. But then, a month later, the government starts selling new bonds that pay 5%. Suddenly, your 3% bond doesn't look so hot, does it? It becomes less valuable because nobody would want to buy it from you for full price.
Okay, now we're getting to what is probably the single most powerful and important tool for the average person looking to build long-term wealth. We're talking about index funds and exchange-traded funds, or ETFs. The idea here is revolutionary. Instead of trying to find that one magic company, that one needle in a haystack, these funds let you buy the entire haystack all at once. And honestly, for most people, this is the only investment they'll ever need.
This quote just says it all.
When you buy a broad market index fund, like one that tracks the S&P 500, you are buying a tiny little piece of the 500 biggest companies in America. You're not trying to pick a winner. You're betting on the long-term success of the entire U.S. economy. It is so powerful that most professional, highly paid money managers actually fail to beat this simple strategy over the long run.
So you might hear the terms index fund and ETF thrown around. What's the real difference? It's actually pretty simple. ETFs trade like a stock. You can buy and sell them all day long on an exchange, and their price changes constantly. Index funds, on the other hand, only get priced once per day, after the market closes. For a long-term investor, this difference is pretty minor, but it's still good to know.
So what kind of returns are we talking about here? Well, historically, a big index like the S&P 500 has delivered an average annual return of around 7 to 10%, and that's after you account for inflation. Now, and this is super important to remember, past performance is no guarantee of future results. But it does show you the incredible power of just consistently betting on the growth of the overall economy over time.
And that brings us to the very top of the investment pyramid, buying individual stocks. This means you're not buying the whole haystack anymore. You're trying to find that one specific needle. You're buying a direct ownership stake in a single company. This is the riskiest path, but it also has the potential for the highest reward.
Now, if you pick the next Amazon or Google, the rewards can be absolutely massive, but the risks are just as big. You have to do a ton of homework on every company. The prices can swing up and down like crazy, and it's really hard to get proper diversification on your own. For most beginners, starting with index funds is a much simpler, safer, and more stable strategy.
So there you have it. We've covered why you should invest, what you need to do before you start, and what your main options are. We've laid out all the tools. The only thing left to think about is what you're going to do with them.
Because at the end of the day, that's all money is. It's just a tool. It's a resource that you can use to build the life you want, whether that's financial freedom, security for your family, or the ability to pursue your passions. So the most important question isn't just how to invest, but what kind of future you want to build.